Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. This show gets you actionable insight on everything personal finance, and we speak some days about your expenses, we speak about tax, and we speak about your investments. And we speak about the various instruments that you could use to invest. And often we talk about equity. In the recent past, we've also spoken about multi-asset funds, which allow you to diversify into multiple asset classes. But we don't often talk about bonds, and pure bonds at that, not just corporate bond funds or government bond funds or mutual funds that invest in bonds. I'd like to change that today. And I'd like to talk about public bond issuances and what they mean for you, because you can get rates that are far better than a fixed deposit, and you have the potential to gain in a capital department as well. To talk about this and the opportunity that it presents and everything that you need to know about it, I'm joined today by Vishal Goenka, co-founder of indiabonds.com. Thanks so much, Vishal, for taking the time.
Thank you for having me here.
So let's talk about that. The first thing that I would like to do is to set the context. And here we're talking about debt that is issued by a company, and that is called a corporate bond. But I'm talking about a public corporate bond. How do you differentiate between a normal corporate bond and a public corporate bond?
No, absolutely. I think firstly, the bond market in India is $2.7 trillion. Even bonds issued by certain state entities, state government entities, also called corporate bonds. So corporate bonds is basically issued by a company or a private entity. Public issued bonds are very, very different. They are much like an equity IPO. They are issued to mass retail, and they're issued in denominations of 10,000 rupees only. So for a normal investor, you can choose public issue bonds easily because the price is determined and the entire regulation, the entire paperwork has been done very properly, and you really don't have to figure out where the bond is trading.
Okay, and what is a normal duration of these bonds? It's called, the technical term of course is tenor.
Yes.
But effectively we're talking about how many years, and anything beyond a year is a bond effectively,
That
right?
is right.
And so therefore how many years normally would you have a public bond?
So typically public bond issues gives a wide variety of choice because an investor should match it to his investment goals, how long you need the money for, etc. They could be issued, any public issue says, hey, you can do a 2-year option or a 3-year option or a 5-year option. Seldom we go beyond 5 years in public bonds. And you also have the option of monthly income or monthly interest. So people like to buy a bond to match their monthly EMI outflow. So they said, okay, I will take a 2-year bond, which gives me monthly interest rate, which matches my requirements.
Is that very common? Because often I have seen bonds issued with either annual in most cases or semi-annual in certain cases, but I've very rarely heard of a bond with a monthly coupon. Coupon is what you call it.
Yes, monthly interest payment. No, actually, almost all public issue bonds give investor the option of a monthly coupon.
Interesting.
Yes. So on a platform like ours, we have 30 such bond options where you can say, okay, I can go for a monthly interest rate to match my cash flows.
Okay. And what are the rates that we're talking about? Because, and the reason and the genesis of this conversation, Vishal, is that I came across this fairly large public entity, listed public entity, that issued a bond at 9.3, and if I'm not mistaken, the credit rating was AA. I'm not entirely sure, but that is what determines the rate that you will get. And the higher that you go in the rating scale, if you go towards AAA, the lower the interest that you get. Explain that context.
Absolutely. So the simplest way to understand, and everyone understands a CIBIL score for an individual, right? The higher your score, which means you will be able to borrow money at a lower interest rate. Similarly with companies, the higher their rating. So ratings are nothing, basically the so-called CIBIL score of a company. Rating agencies are regulated by SEBI, and there are 10 levels of ratings from AAA to AA plus to AA right up to BBB minus, being the riskiest part of what we call the curve, right? So depending on the issuer's rating, right? So let's say a government bond, a 5-year government bond is roughly yielding around 6 to 6.25%.
That's the best rating.
That is what we call risk-free risk, right? So it's the government of India, it is risk-free.
Yeah.
You simply say, okay, now for a AAA bond, which is the best rated bond, I will charge something higher than 6.25. And for a AA, something higher. And a single A, something higher. It's not really a science, a bit of an art involved here.
Why do you choose that much higher? Because, and effectively this is risk.
Yes.
And so you're pricing higher because you're compensating for taking a higher risk.
Additional risk.
And this is something that a lot of people don't understand when they go to these bond platforms and they see, whoa, I'm getting a 13% per annum rate. They don't question why. Do you think it's important to communicate the risk factor here?
I think bond platforms are doing a great job by having all the information on the platform. So, SEBI regulation came in 2022 saying if you're buying from firstly, you should only buy from a regulated platform. If you're buying something, all the rating reports, the information memorandum is all there. But to your point, yes, if you see 13%, does not mean it is risk-free. There's a reason it is at 13%, right? So you have to match your risk appetite and actually build a portfolio across government securities, AA, which gives you 8-9%, a single A bond of 10%, and then some portion of your so-called bond portfolio should go off at 12-13.
For a retail investor, and we'll talk about public issuances and how many of these take place, but while we're on the subject of credit ratings and the options available, they're pretty vast at this moment, right? You have so many options available, you can actually just download an application and deploy funds. It's easy to do. So therefore, it's incumbent on us to talk about what the risks are, what the rewards are, what the potential is. You've talked about building a bond portfolio. A lot of people don't understand the nature of building an equity portfolio, which is what we speak about on an ongoing basis. And so they go to mutual funds. Why should they not go to mutual funds when they're talking about individual bonds as well?
Very good question. So I think debt mutual funds, investment in them, and individual bond investment is much like investing in equity mutual funds or single equity, right? So there are pros and cons. So debt mutual funds, the benefit is that you have a specialized asset manager expert. You have easy exit on the NAV because you could liquidate your debt mutual fund in a day mostly, right? The flip side to that is that it gives you a blended rate of around, historically in India, between 6.5% to 7.5%. So you get the ease of liquidity and easy exit. Were you to build your own bond portfolio, you could try and make 9 to 10% on a blended basis. So for that time you're spending, it's your own money, so just spend some time, information is available, you could do that. So really we tell people that a fixed income portfolio should have a component of debt mutual fund, but you could earn higher money if you do it yourself.
So it's like diversification within that bond portfolio as well, and you're layering the top, just like you would talk about in an equity portfolio. You would say you have a core portfolio and you have a satellite portfolio. The satellite is what gives you that edge, is what layers your returns over a period of time. You take that at the cost of higher risk. So but then you're taking it knowing that you have a limited exposure to that. You're not saying, I'm going to put all my money in this 16% bond because it looks fantastic.
Definitely not.
That would be like buying a penny stock.
Yeah, or you don't buy 5 bonds all yielding 13%. Because, let's take an equity analogy. If an industry were to suffer, you see all the players suffering. So people forget an important aspect in finance called correlation risk. What does that mean? That if there are so many 5 such 13% bonds, they're probably NBFC sector. If one were to get affected, like an SME lending, everyone else will get affected.
You saw that when? 2019? Was it ILFS?
No,
so when did ILFS happen?
2018-19, India had its cathartic moment of what I call credit crisis and credit cleansing. And I was very active in my earlier job as a banker and very involved with that. Exactly. Or 2008 financial crisis is about correlation, because if 5 mortgages went bad, you had a domino effect. So it's like buying 5 penny stocks and saying I'm diversified. Clearly you're not.
Okay. So, and here's the thing. A lot of people don't understand why these yields are visible at 13% or 14 or 15%. It's not like the coupon is 13, 14, 15% necessarily. It's that something has changed over the course of a period. It's potential that something has changed over the course of that period. And in the secondary market, it's quoting differently.
Absolutely.
And people, on these bond platforms, effectively, you're buying from the secondary market.
Yes, you are buying from the secondary market.
So if, for example, something has changed in either the interest rate scenario, or if the company is going through a little bit of trouble, then that will reflect in the yields, right?
Yes. So the most pertinent question I get, what's the difference between what we call coupon and yield?
And yield, yes.
Right?
You want to explain that?
Yeah, absolutely. It's very simple. So coupon is the interest rate a company is going to pay you, which is decided at the time of issuance.
I'm the issuer, you're the recipient.
I am the recipient.
I've said I will give you, or you will give me 1 crore rupees, and I will give you 7% per year.
For the next 3 years.
For the next 3 years.
Speaking.
So every year you will get 7%.
Absolutely.
But then if the interest rates have gone up,
Yes.
and I'm still paying you 7%, the value of that bond is now lower.
Going down. Yes.
And so therefore when you sell it at a loss.
Yes.
And so therefore the person who's getting it
Might buy it at 8%. So yield in English term means returns, nothing
Sure.
else, right? Yield on a crop, yield on a bond. So simply, once you have issued the bond, it could move up or down in price.
depending on either the interest rate scenario or the credit profile of the company.
Or the credit profile, perfect. These two important things, either level of interest rates in the economy have gone up or down, or your credit profile has improved or deteriorated.
So the reason why I wanted to have this conversation, Vishal, is that it is not as simple as it seems. It's not a fixed deposit. You have to track the company whose debt you own. And
Yes.
so with that caveat, public issuances, how many have taken place? And between buying a public issue, which is somebody who's maybe cutting their teeth in the corporate bond market, it's an issue. You look at the rating, a minimum rating is BBB, that is investment grade, and you should ideally gravitate towards
single A, double A.
single A, double A,
Yes.
right? Or triple A.
Yes.
Triple A, you would not necessarily get a great rate
Yes.
comparatively,
Yes.
but then you gravitate to the good rated bonds if you're cutting your teeth, right? Advantages of public bond versus secondary market corporate bond?
So the answer lies in your question, which is, let's say this year alone, about 15 public bond issuances have happened this financial year, worth 5,000 crore. However, in the private corporate bond market, 4,66,000 crores of bond issuances have happened. So public issues give you 1 or 1.5% of the total issuance. So it might reduce the flexibility you have, flexibility of choice, flexibility of names, and there are a lot of serial issuers, like some of the larger companies issue 3 to 4 times in a year. I think therein lies the difference.
Can you buy a public bond issue in the secondary market once it's issued?
Absolutely. It's like equity, because people understand equity. There's an IPO, which is the first time equity issuance, and then the equity trades.
Is it true that these bonds yield higher than the normal bonds in the secondary market? Or, I mean, when they're issued on a private placement basis, which is when these large investors come in and buy, and if it's a public issuance, the same issuer, do they price their public issues a little higher?
It's a very good question. No, so whether public issues come higher or lower than the secondary market is a function of a whole lot of things. Size of the issue.
Sure.
You know, an issuer could have 10,000 crores of bonds trading at a 100 crore price, really much tighter. But interestingly, SEBI came up with this consulting paper only 2 weeks ago.
Oh, interesting.
So very timely, whereby it's asked for public opinion that public issue bonds should have a preferential rate for people like senior citizens, for women, and also for retail to encourage mass participation.
And once that comes through, I'm sure that we'll talk about it more.
No, absolutely. I mean, it's to encourage participation. It's to move the savings to financialization, as we call it.
So I think we've had a great conversation, at least getting people thinking about bonds and thinking about public issuances and diversifying their portfolio. So
Absolutely.
I think the first few steps may just be taken. And I would like to invite everybody watching to write into us and tell us what you'd like to know beyond this. We've kind of given you a little more than just the surface on how bonds work and what you should look forward to. We haven't really talked about the tax aspect of it, how they relate to mutual funds, and how mutual fund debt instruments or debt funds are taxed, and whether you're at an advantage if you're going individual. We'll talk about all of that on a future episode. Vishal, it's been an absolute pleasure. Thanks so much.
Thank you for having me over.